What's up, guys? Welcome back to another episode of Victor Rock channel. So today in this episode, which is the second episode of technical analysis, in this video series I'm going to give a full introduction of basic technical analysis knowledge that you need to know before you trade. This is very important because a lot of traders enter the market without understanding the very basic concept. If you do so, it's very likely that you're going to lose a lot of money. So in this video series, I'm going to teach you step by step how to understand the basic principle and how you be able to apply all these knowledge and concept in your real life trading. So we will jump right back to the content in this episode. So in the last episode, we talked about resistance and we talk about support, and in this episode we're gonna talk about we have to understand the very basic concept of trend line. So as you can see from the chart right here on the right side, as you can see, if we kind of link all the new low and new high together, we'll be able to get a trend line just like this. So note that here, as you can see, this is the previous low and this is the new low, and then etc. So we kind of just link all these points all together, and that, you know, we would do the same thing to the high points as well. So therefore we are getting these horizontal line, we're getting these kind of line, you know, so telling us what the trend would be. So this is a good way of showing other traders of a particular trend. But we should also note that from this chart right here, it's very easy. For example, when you're when the market actually drops, you know, backward, and it kind of breaks these trend lines. So we're seeing these this is a reverse pricing signal. So in this from this chart, you'll be able to see, first of all, these assets actually have a main trending line which is upward, and then the technical indicator indicates that the trend line was being broken. So that's why you have a reverse trading pattern, and then the price further, you know, fall down, and that's what you can read and use the trend line for. So basically from this chart you can see this is the trend line being broke, which is really similar to the chart from the right side. So you can see, as you can see here, the trend line is broken. That means that the market is likely to fall, and which is reverse. And right now, as you can see from the below chart, that trend line is broken. That means when you're seeing this trend line being broken, and then the market kind of breaks that trend line, and as you can see, this is a very upward and reverse kind of a market momentum. So this is the basic idea of trend line. So in a trend line, resistance level can either be drawn by a horizontal line, or it can be uptrending or downtrending line. Just like what we have said, trend line is nothing more than a just straight line, and you should draw between at least 3 points. Okay, so you're not going to draw with a 2 points. It's impossible to do that with only 1 point. But if you want to draw a trend line, make sure you hit that, you know, 3 points, and that gives you a very direct perspective, and that gives you a clearer view of what the market structure is. So for a downtrend, the peaks are connected. The important point is that you should not draw over the price action. Okay, so trend line must incorporate all of the price data. That means we have to view the price chart from a more of macro perspective. Okay, so when we're doing a lot of trading, it is very important that you do analysis for yourself. This is like a homework for a trader. Every time before you trade, you have to do proper homework. You have to draw these lines, you have to understand all these indicators, put that on the paper, and draw for yourself, so that you will have a very direct understanding of what the market is going through right now. Okay, so some analysts would use 2-day rule, meaning that the trend only seen as broken if the price closes above or below the trend line for at least 2 days. So if that trend doesn't last for at least 2 days, that means these would probably not be able to seen as a reverse kind of momentum. Okay, and some people, they also use 1% stop, and it could be higher if this should be compared with the market volatility, and that meaning that trend is only seen as broken if price close over 1% and above the below trend. So what would be the difference? The big difference between the 2-day rule is that it is mostly applied by intraday traders or traders who tend to trade in large shorter time frame, and people who are using these 1% stop rule, these people are those kind of we'll call this institutional traders. They trade larger amount of capital, and they're also trading with a longer time frame. So there is a significant difference between different rules, because according to the capital that you're trading, people who are trading only $100 would have a significant difference between people who are trading $1 billion, right? That's for sure, right? So here, as we can see, this is how we determine different time frame. It is so important when you're trading, right? This is happen very commonly in our daily life. Like people, like maybe your friends or relatives, just tells you, okay, I think you're gonna buy some Apple stock, and that doesn't mean anything because he doesn't mention of the particular price he's gonna buy. He didn't mention the how bullish is he, and what price does he actually think that Apple stock is gonna hit. And he didn't tell you about the fact that what time frame he's going to trade. Is he going to hold the stock for 1 year, or is he going to hold the stock for 30 minutes? Well, he doesn't give you all the details. So what's going to happen is that you're probably going to miss a lot of very important details when you're trading with different time frame. So you have to understand specific details of how long you're going to trade, and you're going to understand how long are you going to hold for this position. Therefore, it's very important for us to understand different time frame. That we call this as hours. For example, if you are reading the hours chart, then that usually means the longer term. Okay, so when you're looking at those hours chart, you just like a clock. Here, as you see, this is the longest time frame in the clock. So if you're looking at hours, you're looking at monthly, you're looking at yearly kind of performance. If you're looking at a yearly performance, you're probably going to hold the stock for at least 1 year. Okay, and minutes, as we're going to see from the clock, this is the second largest time frame, which is minutes. So it kind of lasts like quarterly basis. That means if we're going to trade a stock, we are going to hold the stock at least for a quarter. All right, we're going to hold it for a quarter. So more of a speculator perspective. And here, as we can see, the lesson one, which is the seconds. All right, the seconds, that mean you're holding this stock for a very short-term trend. You may hold this stock for less for a quarter, or maybe less for a month. All right, it doesn't matter if you're holding it for maybe hours, holding it for maybe a couple days. You can view this as seconds, because that means you're going to hold the stock for a lot smaller time frame. Okay, so you have to decide. Most of the people who are long-term investors, they're holding stock for more than 12 months. All right, people who are speculators, they speculate in around 3 to 6 months. Seconds, directly for the people who are more speculator types, you're taking advantage of market volatility. So this is the very important concept, investment horizons. Okay, so as a trader or as an investor, you have to understand what is the investment horizon is going to hold for specific stock. Okay, if somebody tells you to buy the stock, buy the dollar because it's going to rise, you should make sure that you have to understand if that dollar is going to rise for a couple days or a couple months, or you will just end up having lost mind entirely. You will, end up losing the entire picture of the time frame going to hold, right? So a lot of investors make very similar mistakes. They try to speculate, but then they lose money, and then they soon convince themselves, I'm going to be a long-term investor. I'm just going to tell you, like, in my career, I've seen that ordinary people, they are just repeating the same mistake over and over again, and that is the reason why you're losing a lot of money in the market. It's not because they don't know all these technical analysis, it's because they have their basic wrong. Okay, so this is why I'm sending you this very important warning that you have to understand the horizon, the spectrum that you're going to hold for specific stock. Okay, here, so we can, because right now we have a clearer view of time frame. Now we can understand the basic idea and the basic concepts of market trends more clearly. So right now is here, as you can see, this is a long-term trend with the very thick line right here, and you can see like thinner line right here, which is representing the midterm, and the red line right here representing the short-term trends. So as a trader, you have to understand what kind of trends you're going to trade. Are you going to trade the long-term trends? If you're going to trade for long-term trends, that will require more capital, that will require more energy and more holding period. If you're trading for midterm, that you're definitely going to avoid using too much of leverage, because in the long run, you'll probably be squeezed by the volatility. In a short-term trends, that's more likely you're going to use more leverage. That's likely how you're going to trade more in a speculative kind of manner. Okay, so here we can understand there are different structure of the trend. So we all understand the stock, either it goes up or it goes down. Okay, sometimes it goes horizontally. Okay, so we have different terms for the different structure of the trend. So we talked about uptrends, for example, higher peak and higher troughs, and we talk about downtrends, lower peaks and lower troughs, and sideways trends or consolidation. So that means you have a horizontal peak and troughs. Okay, so you have three different structures. Okay, so it's very important, because you cannot expect the stock to go up all the time, right? For we're having like 252 trading days approximately for a year, right? So sometimes it's not like the stock is going to just go up and up and up, right? Sometimes it goes slowly like backward, and then sometimes it goes like horizontally, a bit of consolidation, and that is how it works. So we have to understand there are different structure of the stocks. So you need to have patience when you're trading. Patience is the gold. Most of people, they make money, but they only make money like on paper. They didn't withdraw that kind of money out. They didn't, close the position for profit. The reason why is because they are not patient enough. Either they're just too greedy. All right, say they make money on the uptrend, and then they want to quickly make another same amount of money, so that's why they close their position. They reopen their position without understanding the market structure. All right, so and then maybe the stock goes sideways, and then he kind of quickly open it and close it, try to trade a sideways. So what was the result? The result is that the guy is probably going to lose all his profit plus the money he owns by trading sideways, because it could go up, it could go down, right? It's very difficult for you to make money in sideways. Okay, so most of the in my career, I make money mostly on uptrends and downtrends. Okay, so these corrections are midterm, and if we look at the birth chart, for example, the U.S. dollar and Swiss franc trends, uptrend will be 1995 to 1997. That's a long term. We call this primary trend, which is the hours. It was broken by the 1998 decline. Okay, so but if you want to trade that kind of big trend, it's so important that you should have a big capital, big size of capital. So if you are just holding $10,000, I don't suspect that you can trade for that significant amount of volatility. And the long-term trend is not a straight line, but it is interrupted by corrections of a smaller degree. If you have a very small capital amount, the money that you manage, it's very likely that you're going to get wiped out because of the smaller correction during these 1995 to 1997 primary trend. And most of the corrections, I would say, are the medium term. Okay, they are the minutes. We also call this intermediate term trends, or named as secondary trends. So these correction, it's not a straight line, and sometimes is made up with smaller correction. So if you are speculators, these are probably the most of the volatility, most of the profit would be generated from. You'll be able to understand when it corrects, and then that would be a good time for you to put on another good position. And these smaller trends are also called as the short-term trends, which is referred as minor trends. As you can see that these are seconds. These minor trends, most of the day traders and intraday trader would try to capture this minor volatility. That's how they make money. So a minor downtrend can be part of an immediate term uptrend, which itself can be a part of a longer primary downtrend. As you can see, this is a structure of the trend. You have a primary trend, you have a secondary trend, and you have the minor. Okay, so we have to always step aside of the market and see the total market structure of the price action. So sometimes it's difficult to differentiate between short and mid-term and also long-term. So all these technical analysis skills would help you to understand more deeply of the market structure and also the price actions. And here we move on to very important technical indicators. First of all, we call this moving averages. Okay, moving averages, a lot of people already have heard of it, and this is one of the most common indicators that you use when you're trading. So this is a very popular and versatile trading tool, and they smooth out on fluctuations here. As you can see, this is the actual stock price. It's going up more volatile. As you can see, the market goes back and forth. But with the 5-day moving average, we're basically smoothing the trends and the moving directions of the stock. So therefore, we be able to use these moving average as a way of telling us how to trade. Because right now it looks like a W. It looks like we are going through a reverse market momentum. But here, if we are just seeing the actual price chart, we will be confused by all these smaller corrections. So that's the reason why we have moving average. So everyone knows how to use moving average, but does that mean if you know how to use moving average, you'll be able to trade? I doubt so, because moving average is a tool most of the time, which is just a lagging tool. It has a significant lag when it comes to trading. So it's so difficult to use moving average to time your trade. Okay, so for 5-day moving average, you add those closing 5-day prices for the last 5 closing, divide them by 5, right? Simple math, you get the amount, and you can able to draw that 5-day moving average yourself. Or you can choose, sometimes people choose different moving average. Sometimes people choose 10-day, 40, or maybe 40-week, or it really depends on the time frame that you are trading. If you're trading a large quantity and trading for longer time frame, you choose longer time frame of moving average. And sometimes you will use moving average along with Fibonacci series, which is what we're going to cover in the upcoming episodes. I'll be covering these Fibonacci concepts. You better understand how to use this indicator. So if you want to analyze the short-term trend, you use 13-day, 21-day averages. For mid-term trend, you use 34-day and 55-day average. For long-term trend, you use 89-day and 144-day average. So if you want to analyze a very, very long trend, for example, if you're an economist and whatever, if you're a scholar, you want to do some research, you use the secular trends with 233 days, 377 days, 610 days, and 987 days of moving averages. Okay, so here this is a perfect example. Here you can see the red line is 21 moving average, and the blue line is 5-day average, and the bar charts represents the actual stop price. So this is we can also use SMA. We call this simple moving average. We use that to we get the mean of data set in a given time period. And for example, if 21 SMA would be the data divided by 21 in last 21 days, so you kind of divide it and you get the number out. That's how you get SMA, right? You see the chart. Okay, so this can be calculated at any given time using in the last 21 day. Okay, so average move forwards with each trading day. The moving average usually plotted on the same chart as price movement. So a change in the direction of trend can be indicated by the penetration crossover of SMA. That means if you're seeing a cross between different SMA, is probably there will be a big market momentum generated, and you can see a buy signal or sell signal appear itself. Okay, so it will add confirmation to your technical analysis. But as what we have said before, the moving average naturally lags behind the price movement. So extent by which it lags is a function of the time span. So that means if we're gonna to properly time our trades and properly position our trades, we have to also use other technical indicators as well to help us understand the market structure. So the shorter the moving average, the more sensitive it is. So the 5-day moving average will react more quickly compared to 21-day. Again, it all relates to the time spectrum that you want to trade. Some people, they love to trade daily. Some people, they love to trade on a weekly basis. Different people have different time frame that they're good at. Okay, and here this is a perfect example of showing you how to use SMA. Right here is, you can see 30-month and 21-month moving average showing the long-term trend. Here you're seeing the mid-term trend. Okay, so here is the Swiss market index daily chart. As you can see, this is a shorter time frame because this is 13-day and 21-day of moving average. So okay, so we can incorporate 2 basic moving average to track 3 investment horizons. So okay, so this is the chart. Here I want to talk about this very important picture here. This is 21 moving average, and this is 55-day moving average, and this is 144-day moving average, which is the deep blue right here. So the best performance is achieved when long-term average is rising above mid-term average, and both are rising above the long-term moving average. So that means the shorter time frame of moving average is more sensitive compared to longer time frame. As you can see, it first jump up, and as you can see, it kind of gives you the information of markets going up very clearly and very quickly. Because right here, as you can see, in a very early stage, the 5-day moving average already reflect the price is going up. And here, moving average crossover. It's a very, very important concept, because the 21-day moving average shown here in a shorter time frame, and here with these 55-day, there is a cross right here, and there is also another cross with 5-day and 144-day, and there is a cross right here, 144-day with 55-day. So buy and sell signals are given when the price crosses the moving average, or the moving average itself change direction, or when the moving average cross each other. So as you can see, there are different buy points and sell points. Okay, so B1 is the buy points. So when you're seeing this shorter time frame, and S1 is the sell point right here. And here you see another S1. Here you see another B1. So very easy. When you're seeing the bar charts crossing that 5-day moving average, there is the buy point number 1. When you're seeing the bar charts crossing that 21-day moving average, you see the second selling points. And when you're seeing these bar charts crossing another 21-day moving average, as here have shown, and here comes another buy point, and here's S1, another sell points, is that 21 moving average crosses the bar chart. And then the same thing would work for the buy points 2, B2, S2, and S2 right here. As you can see, for B2, you see this 21 chart crossing these 55-day. You see B2, right? And B3 that you can see 21 crossing that 144, right? So the same would apply for the moving average. So it's very important when you are using moving average, you should as well as many moving average, so you can be sure of the direction, the precise direction that the stock is heading to. A momentum. Momentum is how we measure the rate of increase. Okay, it's like a race car. All right, it's when you are driving a race car and you know it's very fast, but you want to know how fast is it. Is it going to hit 100 kilometers in 3 seconds, or maybe in 5 seconds? So you want to kind of measure the speed of the price trend. That's how you're understanding the concept of momentum. Okay, because moving average, these are lagging indicators. That means the market is using this to give signal after the price trend. Okay, so momentum indicators would lead the pricing trend. That means momentum indicator is a very, very useful market trend, because they give signals before the price trend turns. So you have to understand momentum so you can better time your trade. Okay, so instead of calculating these moving average, maybe the sum of 5 days, maybe a sum of 21 days, you can use the zero line right here. You see this is the zero line, indicator zero line. So you can calculate the 5-day rate of change. You can calculate it yourself, and then you kind of draw a line right here. This is the actual stock price. So whenever that rate of change is above 0, you start seeing a market movement going upward. When the rate of change goes below 0, that stock price is heading down. As you can see, this rate goes a lot faster than the actual stock move, right? So if you, instead of looking at the moving average, you can just draw an indicator zero line and then calculate those 5-day rates of change, and then draw the line. So when it hits below 0, you short. When it hits above 0, you long. Okay, so when you long, that means you're buying the stock. Short, that means you're selling the stock. Okay, to cover in this episode. Thank you guys for listening, and please, if you enjoy